This one's about investing opportunities. And to lead us, we have the lovely and wonderful Chief Inspiration Officer from the Sullivan Adventures LLC and a partner at the New Holland Group. Let's hear it for Jean Sullivan.
So I ask you, where is the money? Where is the money? Is the green rush going to happen again? If you're not familiar with that unbelievable Sanity organogram deal that just happened, well, tune in, go look it up because it's worthy. Just 2 years ago, they were at 9 million top line euros, and 2 years later, 60 million and EBITDA positive. So there's some markers for how to make a pretty interesting liquidity event happen, right? So right here we have unbelievable operators who are making things happen for companies and drawing the attention of investors. Isn't that what it's all about? Getting that financing runway and then getting a liquidity event. That's what it's all about, right? At least part of the journey. So let's meet them because they have so many insights for you. So, Kim, tell everybody who you are and what you're working on.
Sure. I'm Kim Rael. I'm CEO of Azuka. And Azuka is a biotech platform that does advanced formulations for oral delivery of cannabinoids. So licensing model, we have in North America infused now over 700 million units, over 150 licensing agreements. So anything you want to do with oral cannabinoids, we're here to help.
Rachel Wright, Verdant Strategies. We are a financial services firm, fractional CFO services for the cannabis industry solely. And with that, we've been in the industry for over a decade. Thank you.
David?
It's Rachel. David Hyde Advisory. We're cannabis M&A brokers and investment advisors. I've been in the space for about 13 years. We closed almost 50 deals since 2019. So seen a lot of activity and a lot more recently in Europe. So very keen, Jean, to talk through some of the investment angles we're seeing here in Europe.
Raj?
Hi, everyone. My name is Raj Grover. I'm the founder and CEO of High Tide. High Tide is a publicly traded company. We're listed on the NASDAQ, Toronto, and Frankfurt Stock Exchanges. Through our Canna Cabana brand, we are the largest retailer in Canada with 220 locations with over $700 million in annualized revenue. We also have the largest cannabis loyalty program globally with 2.6 million Cabana Club members and 162,000 paid members that pay us $35 a year to shop in our stores. We also own and operate 3 of the top-tier consumption accessory platforms online in the US and 2 of the top-tier online CBD brands in the US as well. And then in September of 2025, late 2025, we entered the medical cannabis market in Germany through a majority stake in Remexian Pharma GmbH. And now we have 10% market share in this country. That's it.
And George?
I'm George Bello. Co-founder of Somai Pharmaceutical, CEO of Somai Pharmaceutical, 2 facilities in Portugal, EU GMP 1 and 2, currently in 6 countries, plan to be in 12 countries, one of the largest manufacturing extract facilities, plus we represent many wonderful brands such as Aero, which is the second medical inhalation device in the market, Cookies, and as well as Sherbinski's, Jacker, and other Thai brands as well.
That's it.
That's it.
Pretty impressive crowd we got up here, wouldn't you say? So let's start with what's going on, like I call it policy pulse. What's happening around investment? David, lead off. Tell us what your thoughts are about. Are there changes happening in Europe? What shifts are you seeing? Because you've been so active with both M&A and financing. So talk to us, share those insights.
Yeah, thanks, Gene. I think one of the big drivers of investors and people looking at the space is the regulatory kind of uncertainty that's in play. Certainly we've seen things like Portugal, like North Macedonia, some of the protectionism in Australia to a degree, in Israel, but we're also seeing now, of course, in Germany, there's questions around the strictness of the regulations with respect to conversion, and questions about, is that going to go more widespread? Is it going to be limited to certain states? So there's a lot of kind of turmoil, if you will, on the regulatory side. And then I think when you look at another trend is also cash shortages. Your cash sensitivity is such a big issue. The cost of borrowing is very high. The long lead cycles of getting paid for the product kind of counteracts with that as well. So it becomes very difficult. So despite those headwinds, we've seen an uptick in M&A. We've certainly seen some big deals happening. Most recently, the Sanity organogram, of course, is the biggest deal recently, but there's quite a lot cooking, and we're aware of some deals that are coming down the pipe. So it's exciting times for investment and for M&A, but again, it's cautious times for the investors.
So is all that you shared just now going to keep people back from investing? You know, it's one thing to have M&A, seek those liquidity events, but what about the risk part that investors might feel? Speak to that, Rachel and David, because that's not like it was for all of us in the U.S. during the go-go time. So speak to that. What are your thoughts?
Yeah, so I'd say David set the stage here for a complex regulatory framework, and I'm sure everybody's been hearing that all day today. How complicated is it? Everybody's looking for opportunities of entry, whether from an investor or an operator standpoint. And what I'd say is, if we've learned anything in such a complex industry, get ready for things to take, I want to say 10 times as long and 10 times as much money, maybe, maybe even more, who knows? Just be prepared, because things are not going to go exactly as you think they're going to go. I work with folks that have waited for, say, retail stores to open for a long period of time. They've had to put money out for rent and all these different expenses that they were not planning on because the regulatory agencies didn't allow them to open their stores in time, right, for when exactly they planned on opening. So now they've had to come out of pocket, right? And their investors weren't planning on that. So just expect the unexpected, be prepared, and yeah.
But when we talked, you brought up the fact the long game is so important. Speak to that, because you deal with over 600 cannabis operators. That's just an amazing fleet of issues to deal with and all. So tell us your thoughts about that, how you've seen people prepare for that long game.
I don't think I've seen people prepare for the long game. I think I've seen them forced to prepare for the long game, reactionary. So I think instead of being reactionary, like I said, just kind of plan for that long game. Just think long term. Yep.
Well, go ahead, Kim.
Yeah, I was going to add to that, Rachel. I think one of the big mistakes that we saw in North America with the green rush was people investing and kind of playing on a field that wasn't there yet, and that field never materialized from a regulatory perspective. So billions have been lost. So I really think that what my advice would be in this world is to play on the field we have, plan for the future, but don't build infrastructure betting on regulatory changes to happen in 2 to 4 years, because it's probably not going to happen, and you're going to have an incredible cash drain like what we've seen in North America.
Well, Rachel, you know how you said you haven't seen too many plan for the long game? I know somebody who has, and that's Raj Grover. So you talk to us about these more than 200 stores you have opened in Canada. That's just amazing. And how did you do that? And you're profitable, which is also unique. So talk to us about that, what that's all about, and that versus, days where it wasn't that way.
Yeah, for sure. So, growth, and the biggest lesson that we've learned over this period of time is that growth and profitability don't have to be mutually exclusive. In the beginning, when the games begun or legalization happened, I saw a lot of operators just wanted to scale as quickly as possible. That was not the High Tide way. We took a differentiated approach. We really focused on strong site selection criteria, strong average unit economics, and really focused on procurement expertise and strong cost controls. You have to do all of that. And I think that's really paid dividends for High Tide today. We're also a non-vertically integrated company, which actually means that we don't compete with our suppliers. So we can procure best-in-class terms, which is also differentiated. I hear many people saying vertical integration is the way to go. Maybe not. It just depends where you are in that value chain. And then, we are the largest procurers or purchasers of cannabis in Canada on a private basis anyway, other than the provincial boards. And what that is doing is continuously strengthening our margins. And because those margins are strengthened, our profitability is stable. And that's very, very important. So we're building a model that's repeatable, that's scalable, that's capital efficient. And I think that's what today's investors are looking for.
But just pressing on that massive number of stores, how did you do that? Did you get, what kind of capital infusion did you have, and how did you entice an investor to believe in your vision?
I didn't really catch the cannabis wave in the beginning. We debuted in December of 2018, which was the worst month in stock market history since the Great Depression.
Yeah.
I was welcomed in the public markets with a 30% decrease in my stock price before reporting any financials. So we had to hustle and flow from the very beginning. And we built a $500 million business, revenue generating business back then, with never having more than 29 million Canadian dollars in our bank. Today we have more. Fortunately, we have more. But it was really every step of the way, you have to remain focused. We focused on organic growth. You've probably seen a lot of press releases from us opening stores here, there, and everywhere with very strong site selection. We put our money to work organically. That was the right way to go about things. We didn't spend revenue multiples, 2, 3, 5 times, which I saw others do. And when you preserve your capital and you're disciplined in your expansion approach, good things happen.
It's a great story, Raj. Good for you. Kim, back to you. So investors want to de-risk their investor. Like we talked a few minutes ago, they don't like all this regulatory uncertainty and waiting to get enough capital to build out your stores and sign your lease. So Kim, speak to some IP protection, other things you can do to really mitigate risk.
Sure. I think that, to Raj's point, you have to figure out where in that cannabis value chain you can be best in the world, right? And so retail is one place. We're best in the world at this sort of special niche in formulations and IP protection around those formulations and licensing. But investors, as you know, look for how do you mitigate product risk, market risk, team risk, regulatory risk in this world. So figure out where you can really hone in and then find partners for the rest, right? Don't reinvent the wheel, because someone in this industry somewhere in the world has probably figured out the rest of the package around what you're trying to do, be it retail or product development or cultivation.
Are they your natural acquirers then? Or you buy them?
Perhaps.
So George, it's another very interesting and big story. Talk to us about what you're doing. You are a multi-country operator. That's that new acronym. Do you know that? MCO. And manufacturing pharma-grade cannabis extracts. Talk to us about how you're navigating all the GMP rigor that you have to go through. And then share with us some of your unbelievable expansion, both plans today and in the future.
The beauty and the wonderful part, if we separate, let's say, United States for a minute, is we can, from one production facility, be able to provide to any country, anywhere in the world that's federally legal. This gives you a massive advantage on being able to scale up. This gives you a massive advantage on not putting so much capital, even though a whole bunch went into SOMI. But it doesn't force you to have to build in each different country your own vertical. You can find the partners that you want in those countries, depending on what you want. As a good example, SOMI has its own distribution company in Australia, whereas in Germany we work with, let's say, our partners and distributors and so forth. UK, same thing. But it allows you to build up your own, let's say, market, and then you can open up your own distribution. You can look at different opportunities or buy, for example, somebody. So today we are in 6 countries. We are in Australia, UK, Germany, Switzerland, Italy, and Portugal. And our plans are to expand into 6 more countries this year. One of the more interesting we were discussing in the background, we plan to go is, for example, Costa Rica. We plan to be in New Zealand, Ireland, some of the Croatian area and things like that. So we're definitely looking to expand. And by the way, obviously France and Spain, because we are one of the few companies that we have 11 QAs, 2 QPs, two regulatory affairs people. We build out the big dossiers to make sure that we can get into those really tough markets. And long term, that's how we see our value. It's not just being able to get into the easy markets, it's getting able to get into the hard markets and being able to provide for our partner brands to be part of those markets as we enter those big, hard, difficult markets to be in.
That's interesting. Tell us more about how it works. Do you ship finished product or?
So depending on the country, it's different rules. So for example, UK and Australia are relatively similar where you can send finished product in. Germany, Switzerland are very similar where it has to be compounded in the pharmacy. And then Italy is also compounding. So that's why we have over 130 SKUs. That we work with. We constantly bring new innovative products to the market. So we launched our Senses line, which was your natural derived terpenes. We have our Origins line, which is your hemp-derived terpenes coming in on the extract side. And then you have like our new product, for example, the Arrow. We have our product for the medical device, so inhalation extract. So we have wide range of portfolio, and also, for example, we're the exclusive grower of cookies flour. So we cover more or less everything that we can, and depending on the country regulations, we bring that in.
What about your buddy Raj sitting next to you? Is he buying your product?
We're announcing, yeah, absolutely. Yeah, we absolutely just did a deal with Raj, and we are now selling our cookies product. You can call it basically exclusively through Raj. So
Pretty good.
Happy to announce
Yeah,
that.
I like that.
Thanks, guys.
All right, now, David, talk to us. You deal with so many investors, buyers, sellers. What is going on as far as investor sophistication? I really want to get to the heart of, is it happening? Is it happening here, even on a global basis? We know what we've been through in the U.S., and it hasn't been pretty. But talk to us about what I'll call investor sophistication. Are they taking their wallet out? Who's taking their wallet out? Will they take their wallet out? I think that's what we long for. And so let's start there.
Yeah, there's been a lot of evolution in terms of the investor. I mean, the days of the early Canadian kind of hype and pump and dump, those days are long gone, and the market's learned those lessons. I don't see that being repeated anytime soon. Today's investor tend to be a lot more savvy, more sophisticated. They're taking bets, whether it's short-term bets or long-term bets. The pharma players are longer term, and we're seeing some interesting moves. So who are the investors now? Well, some cannabis companies look at strategic investments. There are opportunities now in a cash-suppressed market to make investments into companies that really value that cash, and then take a piece of that as an investment with your company and get that synergy advantage. We've seen Medios, the specialty pharmaceutical group, that have now signed exclusive deal with Bedrocan. That's a very interesting entry of pharma into the mix, right? Big Tobacco, of course, has made some moves, and there's more moves that I think are in the offing. So certainly I think there's no shortage of groups that are looking at this market saying, look, yes, there are some risks here, but many markets are speculative, and if you know and you can divine the right path through, there's a lot of great investment opportunities in global cannabis. And our phone's ringing more often. Our inboxes are getting more full with inquiries, not just in the cannabis industry, but also from outside. So it's exciting times overall.
How about family offices? Are you seeing more and more there?
I don't know if I'd say seeing more. On that side of the institutional side, they're looking for things like, and there's been some examples, there is some bank lending going on. We saw Inua's $25 million debt deal, which is great, with Deutsche Bank. ATB Financial in Canada has been making loans into the space. These are very good signs, and institutional money tends to back those types of signals. So I'd say there are family offices, institutional investors. They're a little picky. They're looking to pick their spots, but they are out there. And I think the U.S. rescheduling, although it's still very, very early, may help to push that along a little bit if we see some more moves from the U.S. as well.
But there's one thing, though, that it's more of a question maybe, but do you see, because what I see, or the way, at least the feeling I see, is that there's way less, let's call it, potential for new companies to enter the market. So there's way more investors that are willing to take the risk on putting capital into, let's say, a brand new startup company somewhere, anywhere else. Are they looking more at already assets that are already in place and are, trying to be, cash flow growing and positive and so forth? Or are they actually willing to invest into something brand new?
The startup game is really, really tough, right? Investing in startups across cannabis, it's a little bit unfortunate for folks in nascent markets that really ought to have access to funding and find it very, very difficult. If you've got something really unique, that whether it's a pharma play, a medical device play, or something that gives you a domestic place in the market and some differentiation, you can attract capital. But if you're just, I'm going to get a license, I'm going to, kind of follow my dreams, there's not a lot of money for those kind of plays globally.
So everyone who's in the market now is basically, the best contender for that capital.
To a large extent, yes, with the exception of like every great idea has not been cornered yet. There are some really interesting IP-related and other kind of factors that I think will come through and attract investment, but I'd say 90% of what I agree. I think that it would be the existing players in the market now that have proven they had some good quarters, there's some profitability that they're making, they've kind of proven themselves in this tough market, they're going to attract the capital, yes.
I want to just add something to it. So those days of hype are gone. We all know that. Free cash flow generation is real. Investors are demanding, they see that. They want capital efficient platforms to look at. They have options today. They have visibility into which companies are executing, to David's point. And that is the real substance today. To George's point, it's really difficult to get capital for new startups. And that's going to continue because execution is now, it's 8 years in, as a Canadian example, after legalization. There's been a lot of execution, and operators are now, standing out from the ones that are not. And investor dollars are limited. And, retail investors in Canada lost $130 billion alone in that country. So I think the patience is gone. There's no more patience for just startups and just capital markets ideas. There needs to be real substance behind it. At least that's what I'm seeing now.
Interesting. I'll say this, a big mistake I saw and lived through was certainly investing in companies that the product wasn't even there yet, not even an MVP. And I do think that, not across the board, but certainly those days are over. No way. And I'm thrilled to be able to see many, many companies through this Tallman House that, has been put together now for the last year. We put up 4 great companies that we believe are financeable. So I'm saying that also as a 10-second commercial. If you have a company or know somebody that's doing business in Europe, we want to see those and feature them. And that happened yesterday for the Berlin Tallman, just to mention. But we insist on revenue and not just, team in a dream, I like to say. Team in a dream and a PowerPoint. Then I ask if they have a dog. You don't have a dog either? So I think it's important that there are real business models. To that end, the actual deal terms are also critical. So David, lead off on that. What are you seeing as far as structuring a deal? And anyone feel free to add in.
Yeah, I'll say a couple of quick ones and pass across to the rest of the team here. I mean, the deal structures have really, really changed. The risk dynamics have evolved quite a lot. So, the investors and the buyers on the M&A side are expecting the seller or the company to take a lot more of the risk, right? And a really good example is the Sanity and OGI deal, right? A big deal, 230 odd million euros, but I'm going to pay half up front and half of the consideration is on the back end when you prove to me that you're going to deliver on these projections. So again, that's just a very good kind of a symbol, if you will, of what we see in the market. The deal structures are much more less cash up front, less cash consideration, more longer term value creation, tying milestone payments or earn-outs to future deliverables with the uncertainty that's around. And the cash is difficult. So we deal with shareholders that have hard decisions to make. Do I want to take a bet today on an investment, but it might not be just exactly the terms that I want, but I'm actually better to do that than to run the risk of being left short down the road. So it's a real struggle. It's a wrestling match back and forward. but the risk equilibrium has really shifted, and the investors feel they have the upper hand right now, and that's just the way that this market is.
Yeah, as an example, we're looking at companies as a multiple of EBITDA, not a multiple of revenue. Profitability is critical. And if they're not profitable, we're not coming in and putting our dollars on the line for them to just, say, okay, we're going to keep our promise. That's not how it works in today's environment anyway. And I think you're going to see more multiples of EBITDA versus multiples of revenue.
I'd say everything's like data-driven now, which is very refreshing to see. You can reverse engineer EBITDA, to try to figure out where the lines of profitability lie. So, for example, if you know all your fixed costs and you want to aim for a different EBITDA, there's different ways to do that. So I love seeing that there's data-driven decisions now. That is very refreshing, and a lot of market research, to your point. Researching which markets and which parts of the vertical you want to get into rather than just kind of spraying money all over the place. I love seeing that because we've been through the green rush. We've seen money spent. We've seen multiples of valuation on companies that weren't worth, the money it was printed on or advertised on or anything like that. And we're still seeing that, frankly, now today as well. So there's still dangers of it, especially in new markets. But data-driven is everything.
But I would just, one final thing I would add to that. It's not only from the investor side. I also see, let's say, certain mergers happening in the market with unrealistic, also, let's say, valuations that come behind that. Right. And I think that will also hurt long term, especially if they try to raise down the line and things like that when you have those unrealistic. So I think there's a lot more mergers coming down the pipeline just because the investment is not there today. Let's say you don't have the investors, so you're forced to kind of basically find that vertical integration or find that partner you want to be part of. But then you also have to make it realistic, and it has to be long-term, also forward-looking, because otherwise you'll never raise money against that.
Well, and that's the long-term sustainability of the market. If there's these massive valuations that aren't realistic, and investors don't get their return, ROI, that's going to lower investor confidence and damage the industry in the future as well. So let's make sure that the valuations are realistic for the industry as a whole, and to set expectations properly.
And seeing one big deal with a high valuation doesn't set the market, right? I mean, if you see a large valuation deal, there's a lot of dynamics that maybe we're not even aware of that actually fueled the reality of that deal. So you've got to look at it from not just that single deal, hey, that one was 20x, so therefore that's what my business is worth. It doesn't work like that. It's individual, and it's also what people are prepared to do. And to George's point, we have people that came to us as a merger in play. They can't come to agreement. I never want to talk to these guys again. 6 months later, they're back at the table because people realize this is the best deal that I might get these days, and I'm going to have to talk.
Now, every deal I'm seeing does have a profit distribution. And I haven't heard you mention that because people don't necessarily want to wait for a liquidity event. But are you seeing that in some of these European deals? Even for you, like Raj, and the deal you did, was there any chance for them to get a liquidity event along the way rather than waiting to to an exit?
The deal that I did was not an inbound into me. I reached out to them, but it was an opportunistic deal for both sides. They knew we were coming. We had a personality match in terms of their affordable pricing in Germany and our lowest price guaranteed, so it was very opportunistic on both sides. But I think the Remexian management was smart. Business never goes up in a straight line. It goes up and down. And when you have momentum, right, every market, when it takes off, it's a very exciting market. It's roaring and going, but everything eventually settles. And you can never time it perfectly. So if you're on the rise, you take some dollars off the table, and that's what they did. They still kept 49%, and we acquired a 51% stake.
Yeah, I really believe in that. Are you seeing that, David, in some of the deals you're doing?
It's really hard, Gene, for founders to take money off the table. I mean, that's just the reality. It's very, very difficult now. Yeah, I mean, talk to Raj if you've got something really, really interesting. But no, it is tough. I mean, again, to my point earlier, I think more and more we're seeing that the founder might get a little bit of cash off the table, but more often than not, they're having to play the longer game, stay involved, prove out their thesis and take money over time in a kind of an earn-out structure, it is exceptionally difficult to get cash out now. And frankly, the new people coming in or the investor or buyer doesn't want to put money in that's just going to jump out. They want to put money in to grow that business. So the founders or the shareholders taking out a lot of the money just doesn't fit with that thesis.
And I was going to say, operators and founders, sometimes you'll get an offer of stock, right? And so that's a bright, shiny object. You have to be very careful of that. You have to do just as much due diligence on the company that's offering you stock in their company as they are offering you some cash as an incentive. So that company may not be worth anything at the end of the day.
Kim?
Can I just say that it's not all gloom and doom, right? Because one of the advantages of being in a cash-constrained environment is you learn how to operate efficiently and how to become cash flow positive. And cash is king. So, when we were raising money 8 years ago and Gene didn't invest in us, it forced us to grow a business. It's okay, we're good. We're good, Gene. But it forced us to grow in a very capital efficient way and become profitable very, very early, which, I would have loved to have raised more money, but in retrospect, I'm glad that I didn't. So to operators out there who are finding it hard to raise capital, I mean, there's a flip side to that coin, right? Which is that constraint can actually become your secret weapon. So it's just not all gloom and doom.
And back to you, Raj, that's exactly what you've tried to create, especially with the moat. And that moat is around some loyalty that you've created. So tell us that story.
Yeah, I think loyalty is one of the most underrated moats in cannabis retail today. And we're very fortunate through the Cabana Club. We build millions of members that give us access into consumer insights. So we know what they want to buy, when they want to buy, what they prefer. We can cater to what they're really looking for. That's the power of loyalty. And I see, many companies have not focused on that. When you are in a commodity type business, which cannabis is, whether we like it or not, it's very important to own that last mile customer relationship. And if you don't have that, you really don't have any moat. And I just don't see that happening. So we build an ecosystem that's not just retail. That's a cannabis loyalty-focused ecosystem, which becomes even more powerful when we scale.
Now, are you going to do that with Remexian too?
Look, we're already at 10.5% market share with Remexian in Germany. We're at 12% market share in Canada, but I think we will exceed Canadian market share in Germany here. I think we'll touch 15 to 20% in Germany in the long term.
So we just got the word that we should wrap it up, but let's field one or two questions.
You can do one or two. Well, let's hear it again. For this has been a great panel. That's fantastic. Does anyone have a brief question? Look, you've educated them all perfectly. They don't need to know anymore.
How's this for a goodie? Does anyone have a great company you want to tell me about? Not right now, but find me. I'm here all day today and tomorrow. So.
You have a question?
Oh, no, I have a great company, but I
All right,
that's fantastic.
You find me after this.
They'll all be over that way. Let's hear it again for this panel right now. We're going to try to catch up on time.